Hi friends, welcome to the channel JIV and CIV Made Simple. So this is our unit number 8 of AVFM theory portion, and we are talking about the chapter name is financial and operating leverage. So first of all, let's see what are the topic which we have to study in this particular chapter. We will see the objective, introduction, financial leverage. This is a numerical topic. I tell you that it is 80% numerical, 20% theoretical, but you have to go through this numerical aspect each and every point. I will make it clear in super simple way. There is some trick which I will tell you throughout the lesson. If you go through the entire lesson, you will understand those tricks, how to easily do the calculation using this trick. So we will see what is financial leverage, what is degree of financial leverage, how it behaves, what is operating leverage, what is degree of operating leverage, and how it behaves, and we will see the combined or total leverage. So these are the 6 topics which we will go through. So let's start with the first topic, that is our introduction. So let's understand the lever principle in a business, right? So have you ever seen a small kid lift a heavier one on a seesaw? Sound impossible, right? But with the right balance, even a lighter person can lift a heavy one. This is the power of leverage, right? So the power of leverage is that even a lighter person can lift a heavy one, and this is the power of something we call leverage, right? So this is the power of leverage. That means using a small force to create a big impact. So basically, what is leverage? We are using a small force to create big impact, right? This is called leverage. So, but did you know the same principle apply in business and finance? Let's break it down in the simplest way possible. You know, in physics, a lever help us do more with less effort. Obviously, that is the power of lever. How does lever help us? Lever help us to do more with less effort. And you know, Galileo once said that when we give me a point of support, I can lift the earth. So that is what Galileo told. Give me a point of support and I can lift the earth, right? So now imagine applying this idea to business, right? So apply the same idea that the Galileo told. Give me a point of support and I can lift the earth, right? So imagine applying this idea to business, where we use operating leverage, right? We use operating leverage to boost efficiency, right? So where operating leverage is used to boost our efficiency, right? And financial leverage is used to multiply profits. So financial leverage is used to multiply our profits. So let's dive into this world. But how does this work? So just I have given you a trailer that operating leverage is used to boost efficiency and financial leverage is used to boost our profit. But how does this work? Let's dive into financial leverage first. First of all, let's talk about this so-called financial leverage. What is financial leverage? Think of a business owner who want to expand. Instead of selling more share and diluting ownership, they borrow money to fund growth, right? Obviously, when you know very well that when they will sell share, obviously their ownership will get diluted, because those person who are buying the share, they will also become owner of it. So obviously the ownership is getting diluted. So instead of selling more share and diluting ownership, they borrow money. What did this company do? The business do? The business borrow money. This is the key point to note. The business borrow money, right, to fund growth. They have to fund their growth. That is why they borrow money. Why? Because if they use the borrowed money wisely, they can earn more profit than the cost of borrowing. Yes, that is the key point, that they have to use the borrowed money wisely. They have to use the borrowed money wisely. How to use it wisely, that is what we will go through, right? So if they use their borrowed money wisely, they can earn more profit than the cost of borrowing, right? So that is the point. Enhance their return on investment. They can earn more than the cost. Obviously for borrowing they will pay interest, that is called cost of borrowing, but they can earn more, right? So this increases their EPS means what? Earning per share. This increases their earning per share. What is earning per share? This earning per share is like a report card for shareholder. So this earning per share is like a report card for whom? Report card for shareholder, right? In simple terms, it is like using a loan to buy a high yield investment. You have taken a loan, and what are you using loan for? You are using loan for a high yield investment, right? You are using your loan for high yield investment. So if the return are higher than the interest, obviously you win big. So the cost of borrowing is what? Cost of borrowing is the interest you will pay since you have borrowed, right? So cost of borrowing is the interest you will pay, and if the return is higher than the cost of borrowing, obviously that is the point we need, right? So But wait, does financial leverage always work, or is there any catch? Stay tuned as we explore both the power and the risk of leverage in the next part. Don't forget to like, share and subscribe if you are finding this CAIB concept easy to understand. Now let's understand the EPS enhancement. So EPS is like an scorecard, a report card, right, for the shareholder, right? That is called earning per share. So friends, now let's talk about this so-called EPS enhancement. What is the meaning of this EPS enhancement? So friends, imagine you have started a business, but you don't have enough money. What would you do? Borrow, right? But what if I told you that borrowing could actually make you richer, right? What if I told you that borrowing could make you richer? Sound risky? Well, welcome to the world of financial leverage, where using debt smartly can boost profit or break a business if not handled wisely. So it is a trade-off, right? If you use your debt wisely, it can boost your profit, right? It can boost your profit if you use it wisely, or it can break a business. It has capacity to break a business if not used wisely, if not handled wisely. Let's simplify this concept in a way you will never forget. So let's talk about the power and risk of financial leverage. You know, financial leverage is about using borrowed money to make more money, right? How it works: the first is EPS booster, or we call it EPS enhancement. You know, borrowing instead of selling share help business grow without giving up ownership. So borrowing instead of selling share, we are not selling share, rather we are borrowing. How does it help business? Because it grow without giving up ownership, right? Because without additional equity investment, means company did not give ownership, so it helped the company business grow. So you know, more profit, basically what is happening, more profit, shareholder is the same, so it is a win-win situation, right? And you know, there is something called debt plus capital. Debt plus capital is the combination is called growth. See, debt plus capital, these two combination is what we call growth, right? So you know, a smart business mixed borrowed money with their own fund to expand faster and increase their company's value, right? So those businesses who are smart, they mix borrowed money with their own fund to expand fast. What's the capital? Capital is nothing but their own fund, with the fund which has been provided by the promoters, or we call it the owner fund is called capital. So debt plus own capital, right, to expand faster, increase their company value. But there is risk factor. Let's talk about the risk factor. You know, but hold on, more debt means higher interest payment. Obviously if you are taking more debt, obviously interest payment will be higher. It could be drawing in loan instead of making profit. It could be possible, right? If the business struggle, suppose the business struggle, what will happen? It could be like drawing in the loans, then instead of making a profit. So we have to set limits, that is called prudential limit. That is why company need prudential limit, a fancy way of saying don't take on more debt than you can handle, right? That's called prudential limit. So these are the points which we have to go through. First of all, we talked about the EPS booster, right? Debt plus capital is equal to growth, but there is a risk also. That is why prudential limit is there. Now, how do we measure financial leverage? Yes, very nice question. How do we measure it? Next, now comes the big question. How do we calculate financial leverage? There is no one size fit all method. Remember it. No one size fit all method, right? No method which will fit everywhere. Fit all method, right? But here are the most common one. The first is ratio is called debt to asset ratio. That is how much of the company asset are funded by debt. More debt means more risk. Then second, we have debt to equity ratio, which means compare borrowed money to the owner fund. A high ratio means company relying heavily on loan, right? As the name itself suggests, debt to equity. So obviously if this ratio is higher, it means debt is more, and debt is more, it means that company is relying heavily on the loan. The next ratio we have is the debt to EBI TDA ratio. It checks if the company earn enough to cover its debt before paying tax. So what is this EBI TDA? This EBI TDA is called earning before interest, depreciation, tax and depreciation, right? So basically it tells you how much it checks if the company earn enough to cover its debt before paying tax, right? Because it has not still paid the tax, right? So tax payment is still due. Tax has not been paid, but whatever profit it has earned before paying tax, is it enough to pay debt, to cover its debt? It checks, this ratio checks it. Then we have something called equity multiplier, which means DuPont analysis. What it is, it shows how much asset are funded by shareholder money versus loan. You know, that is the point here, asset funding. right? Means we are purchasing the asset, we are funding the asset. So basically this ratio, that is equity multiplier ratio, tells how much asset funding is done by shareholder money, right? How much asset funding is done by shareholder money versus loan. And there is something called interest coverage ratio, ICR. It measures how easily a business can pay its loan interest. Higher is safer. Interest coverage ratio means how easily can a business pay its loan interest. How easily can a business pay its loan interest? Means if this ratio is higher, if interest coverage ratio is higher, then it means it is safer, because it can easily pay its loan, because it has taken debt. Obviously it has to pay interest. If it can easily pay interest, then it means interest coverage ratio is higher, right? So that is the point. Obviously the higher the ratio, it is safer, this interest coverage ratio. Okay, so in a financial leverage, a magic trick for instance, so my question is a financial leverage a magic trick for instant growth, or is it a dangerous game? The answer depends on how widely it is used. Want to learn where leverage is good and where it is risky? Stay tuned for the next part, right? If you really think that this concept is useful to you, you are able to understand all this ratio, please hit the like button. Now then we have something called degree of financial leverage. So I have just told you that there are some common methods. There is no one size fit all solution, right? But there are some common methods which we can use to calculate the financial leverage, and we have just gone through that. So friends, now let's talk about the degree of financial leverage. So let me ask you a question, that you can think of financial leverage as a double-edged sword. You might have heard of this term. दो धारी तलवार इसको बोलते हैं हिंदी में, डबल एज sword. Why it is called double edged sword? Because it can make your business soar, but if you're not careful, it can also bring you crashing down. Sound scary, right? But let's break it down in a way that makes sense. So you can use the leverage to grow smartly, not dangerously. Obviously there is both the part. There is a two side of the coin. On one side you can see it can help you grow faster, grow rapid, but on the other side this is dangerous also. But how to use leverage so that you can grow smarter, not dangerous, let's understand it. So friends, financial leverage is all about using debt to increase your business return. That is what you are doing now. So suppose this is a seesaw. On one hand you have the debt, on other hand you have the profit. So basically you are using to earn more and more profit, right, to get your return, we call it. So basically, but just like with anything powerful, too much of it can backfire, right? Access is access is always harmful, you know it very well. So just like with any powerful tool, too much of it can backfire. Imagine you are on a seesaw. You imagine at least this is a seesaw. You are on the seesaw, right? Too much weight on one side can make the whole thing topple. That is where what you need to know. So why it is called double-edged sword? Just now we come to know it is called double-edged sword because leverage can either boost profit or make things worse if you overdo it. Think of it as a risk management, right? Risk, manage it well and it works for you. Now let's talk about finding the optimum level. That is the key point. How to find this so-called optimal level? Let's discuss it now. You know that the secret is finding the right balance between equity. What is the meaning of equity? Equity is your own money. Equity is your own money. And there is something called debt. What is the meaning of debt? Debt means borrowed money, right? So basically we have to find the balance between these two, that is equity and the debt, right? Too much debt, too risky. Too little debt, missed opportunity for growth. So right balance between equity and debt is essential, right? Optimum level. If we take too much debt, it is highly risky. If we take too little debt, we have missed opportunity for a growth. So let's talk about the different types of leverage. So when is it okay to use lot of leverage? Let's talk in some example. So let's talk about a small business. For a small company, a little extra debt is not as risky. They can handle it because the stakes are not as high. But here is the catch. But suppose there is a big project. For larger business or big project, too much debt can be disaster. More debt means more risk. Obviously, if you are increasing the debt, it means you are taking risk, isn't it? So more debt is more risk, right? And if the things don't go as planned, you could be in trouble, right? So when it is okay for use a lot of leverage? When you have a small business. You go above the optimum leverage, it's okay, it's manageable because the stakes are not as high. But for big project, if you go above the optimum level, it is quite dangerous. So I hope it is clear now when the optimal level, when we can exceed the optimal level, right? So there is called cost benefit analysis. Now how to calculate it? Let's get a little technical. Don't worry, I will make it simple. The degree of financial leverage, or we call it DFL, let's call it DFL. You know, it is just like it looks at how operating profit, what is the meaning of operating profit? EBIT, earning before interest and tax. How operating profit reacts to the interest expense, how operating profit react to the interest expense, right? That is DFL, what DFL looks at, how operating profit react to interest expense. What does this mean? If the interest you are paying is too high compared to your profit, your EBT and your EPS can swing widely. Try to understand it. Very, very important thing I'm telling you. Two things are there. One thing is EBIT and the other thing is interest. Right? Obviously, since you are taken debt, obviously you are paying interest. So suppose the interest you are paying is very, very larger. Right? If the interest you are paying is too high compared to your profit, if you are paying more interest as compared to your profit, your EBT, your means earning before tax, or your EPS, earning per share, can swing wildly. So there is a wild swing in it. Right, wildly swing, right? Either way, means positive way, negative way. So if the leverage is too high, basically in this case what is happening, leverage is too high, you are taking too much leverage, right? So basically I told you now that this is a, think of it like a seesaw. On one side you have taken your debt, that is interest payment, and on other side you have your profit. So if leverage is too high, means if one side of seesaw is very much heavily weight, that is what is happening here. Interest is larger than profit, means this, for this seesaw one side is heavily weight, that means we have taken most leverage. That means if leverage is too high, even a small change in earning can cause big fluctuation in your profit, right? So that is why EPS, earning per share, earning before tax, these can swing wildly. Means suppose a small change in earning happen, it can cause big fluctuation in your profit. That is the key point here. So what is the takeaway? That financial leverage can be a game changer if you use it right, but too much of it can turn into risky gamble. राइट, लाइक इन दिस केस व्हाट इज हैपनिंग, ट्राई टू अंडरस्टैंड. यहाँ क्या हो रहा है, आपने आपका जो इंटरेस्ट पेमेंट है वो आपके प्रॉफिट से काफ़ी ज़्यादा है. योर इंटरेस्ट पेमेंट इज़ वेरी लार्जर देन योर प्रॉफिट. इस कारण से क्या हुआ, आपने बहुत ज़्यादा लीवरेज ले रखा है. लीवरेज ज़्यादा इसलिए ले रखा है क्योंकि आप सीसॉ की तरह समझिए, एक तरफ आपका इंटरेस्ट है, वन साइड इज योर इंटरेस्ट, अदर साइड इज योर प्रॉफिट. सो यू हैव टेकन एक्सेस लीवरेज, एंड सिंस यू हैव टेकन एक्सेस लीवरेज, एवन इफ ए स्मॉल चेंज इन अर्निंग ऑकर, मान लीजिए अर्निंग में थोड़ा सा चेंज आएगा तो उसका इम्पैक्ट बहुत ज़्यादा पड़ेगा आपके, दैट विल इम्पैक्ट हैविली ऑन योर profit, right, in your profit. That is the point. So that is why optimal level is very important. So I hope you have understand that what is basically DFL. Now let's quantify it. Let's quantify the DFL. So friends, ever wondered how a small change in your profit can cause big fluctuation in your earning, right? Well, that is the magic of the financial leverage, obviously danger also. And today we are going to break down a key concept which we call as degree of financial leverage. Right, don't worry, I will explain it so simple that you will be a DFL expert in no time. Okay, let's get start with the basic. What is DFL? In simple word, DFL shows you how sensitive your earning are to the change in operating profit. That means sensitivity of your earning due to change in your operating profit. So let's say if your operating profit change by 10%, if your profit change by 10%, right? So how much will your earning per share change? Your profit change by 10%, how much will your EPS change? That is the essence of DFL. And what is the formula for DFL? The formula for DFL is percentage change in EPS upon percentage change in EBIT, right? So basically what is EBIT? EBIT is nothing but operating profit, right? And EPS is the share. Sorry. Operating profit is yes, correct, I am correct. Operating profit is EBIT, you know, right? So if your operating profit change by 10%, how much will your EPS change? Right, so sounds a bit complicated, right? Don't worry, here is where it gets interesting. Let's simplify it further. I hope this formula might scare you, so let's simplify it further so that you can understand. So imagine you are tracking your business performance, right? Imagine you are tracking your business performance, right? So what is EBT? You see this word, EBIT. What is EBIT? So EBIT, you know, it is your operating profit. What is the word operating profit means? Operating profit का क्या मतलब होता है? So EBIT is your operating profit. It means sales minus cost. What is profit? Selling price minus cost price, you know it very well, that is called profit. So this is your operating profit. And what is this EBT? What is this EBT? EBT is your earning after subtracting interest expense. So from EBIT, if you have subtracted the interest expense, whatever expense you have incurred on interest, after subtracting you will get EBT. So in real world, EBT and EBIT usually move in the same direction. So changes in one impact the other. here is the refined version of the formula. You can write it like this. We can say that delta EPS upon EPS is equal to delta EBT upon EBT due to constant tax rate and share count. So the formula refined to use. What is the formula? Percentage change in EPS. So it means delta EPS upon, just wait a minute, let me simplify it for you. How do you get this formula? Let me simplify it. So delta EPS upon EPS into 100, that is percentage change in EPS, upon delta EBIT upon EBIT into 100. That is the formula of we call DFL, isn't it? And now what we know, that delta EPS upon EPS, we know it very well, that delta EPS upon EPS is equal to delta EBT, earning before tax, interest payment we have done, upon EBT. So we can replace this delta EPS upon EPS with delta EBT upon EBT, and our formula become delta EBT upon EBT, right, divided by delta EBIT upon EBIT, right. This is what the formula will become. Obviously further simplification, now in the real world EBT and EBIT usually move in the same direction, so change in one impact the other. So here is the refined version of it. So this tells us how sensitive your earning are to the interest payment. Since marginal change in EBIT mirror those in EBIT, so that is why this delta and this delta will cancel. So our formula will be further simplified like this. We can write EBIT upon EBT. This is the further simplified formula, and this formula you have to remember. So this tells us how sensitive your earning are. Obviously EBIT is your operating profit which you are earning to the interest payment, right? If interest is higher, a small change in EBIT can cause bigger swing in EBT and EPS. So question is, why does it matter? Why does it matter? Because simply put, if you have lot of debt, if you have taken a lot of debt, even a smaller change in profit can lead to big change in your earning, right? That is a key takeaway, and this formula you have to remember. DFL is equal to EBIT upon EBT. In another word, if your operating profit, what is your operating profit? EBIT. If your operating profit, or we call it EBIT, is much higher than your earning, that is earning before tax, that is EBT. If EBIT is very larger than EBT after paying, obviously, earning before tax, your DFL is higher. Obviously if EBIT is larger than EBT, it means your DFL is higher, right? And your earning can fluctuate dramatically. If the difference is small, then your leverage is not as risky, right? So you have to ensure that this difference between EBIT and EBT is not larger, because if the concept is clear, it is a ratio between EBIT and EBT, right? EBIT upon EBT. Now how to find this EBIT? I hope you remember the discussion we have done regarding the break-even point. I hope you remember it. If you don't remember it, let me remind you once more, right? I hope you must. There is a trick to remember it. I will tell you. Just let me draw it here. I am looking for some space. Okay, this space is sufficient to make you understand. Suppose this is your pie chart. This represents your total sale. This represents your total sale. Okay, now I told you earlier that you can divide this total sale in two parts. One part is your variable cost, another part is your fixed cost. I hope you remember it, right? And variable cost is always written per unit, right? So just let me show you how variable cost is written. Wait a minute. So this was your total sale, right? So suppose this is your variable cost, right? And this entire portion is what you call as fixed cost, right? This entire portion is what you call as fixed cost. And there is something called, okay, so this entire portion is called your contribution. I hope you know it. This entire portion is called your contribution, and it includes two things. The one part is your fixed cost, and another part is what you call as EBIT. This is your EBIT. So this is how you find EBIT. So what is the formula become? How to find this EBIT? It's quite simple. First of all, you remove this portion. How to remove this portion? You have to subtract variable cost from sale, and then you further remove this portion. Then you further subtract, just in this way you can subtract it. You subtract the fixed cost, right? And whatever is left, your EBIT. That is the formula which is written: sales minus variable cost plus fixed cost excluding interest. right? So this is how you will get EBIT. I hope it is clear. Now once you get EBIT, how to find EBT? EBT is earning before tax and EBIT is earning before interest and tax. So suppose this is your entire earning, this is your entire earning, and it has many component, right? It has many component. So it has component like it includes some interest payment also due it there. You have to pay for interest, right? You have to pay for tax, and finally what is left, your earning. This is your earning. So basically if you remove the tax portion which we have paid, sorry, interest portion which we have paid, then after whatever is left is your EBT. So what we need to do to find EBT, we have to subtract interest from EBIT, right? So these two formula you have to remember. I don't think there is need to remember it, because I have told you a trick to remember it, right? So this formula highlight, this simple yet powerful formula gives you a clear picture of how your profit, interest and leverage work together, impacting your shareholder. So what do you think? Are you ready to use the power of DFL in your business strategy? The right amount of leverage can boost your return, but mismanage it and it could backfire. I want to dive deeper into leverage and learn it how to use it wisely. Hit that like button and subscribe for more CIIB tips. So now let me illustrate some situation for you, right? So that it becomes crystal clear to you. So friends, today we are going to calculate the degree of financial leverage with a real example to show you exactly how it works. Ready to see how small change in profit can make big wave in earning? Let's dive into. Imagine you run a business and you have got all the number lined up. Here is what we know. Your sales are 24 lakh. You can see your sales are 24 lakh, right? And each unit you sell is priced at rupees 100. Means per unit selling price is rupees 100. Your variable cost are 50% of the sale. So that is how much? 12 lakh. 50% is 12 lakh. And you got fixed cost of 10 lakh. You got fixed cost of 10 lakh, right? And you have borrowed 10 lakh at 10% per annum interest rate. And your equity is 10 lakh. Which means your business is split into 10,000. Your business is split into 10,000 shares, because per share cost is rupees 100 and tax rate is 50%. So these data will be provided to us, right? So now let's see how this number come together and calculate the DFL. This question will be asked in examination. So let's break it down step by step. So first of all, we will draw this particular pie chart. This is our favorite pie chart, we will always use. So you start with the sales value, which is nothing but 24 lakh. Okay. Now let me write down 24L to be more precise, right? So I write down here 24L. L means lakh. Now variable cost. So what is variable cost here? So this portion is variable cost, which is how much? 10 lakh. Okay. Now what is your contribution? So contribution is this total amount is how much? No, this is 12 lakh. 12 lakh. Right. This is your contribution is 12 lakh. Right. Now fixed cost. So this portion fixed cost. So this fixed cost is how much? 10 lakh. Right. So what is your EBIT? So EBIT is this portion, this shaded portion. So this is nothing but out of 24, out of 12, if you subtract 10, you will get 2 lakh. So this 2 lakh is our what? This 2 lakh is our EBIT, right? You can see this 2 lakh is our EBIT. So it is our EBIT. So using graph, you need not remember any formula. You can just answer it. Now here is where it get interesting. Let's move on to interest you have to pay. Now how much interest will be paid you have to pay? So you borrow 10 lakh, right? And the interest rate is 10%. That means you pay, what is 10% of 10 lakh? 1 lakh. 10% of 10 lakh कितना होगा? 1 लाख होगा, right? So that means you pay rupees 1 lakh in interest. So after subtracting interest from EBIT, you get how much? So your EBIT is how much? EBIT is 2 lakh. You subtract in 1 year, you pay 1 lakh as interest. So this is your interest. Interest is 1 lakh. So what is your EBT? Your EBT is 1 lakh, right? But don't forget tax. You are paying 50% tax. Clearly written that your tax rate is 50%. So it means you are paying 50% tax. And what is 50% of this 1 lakh? Which is 50,000. So after tax, your earning, your EAT, earning after tax will be 50,000, isn't it? So now let's find out how much earning per share is, right? Obviously we need to find the EPS, earning per share. So how to find this EPS? Let's understand it here. How to find this EPS? So what we need to do, after tax, we have paid interest, and whatever is left is our earning, isn't it? टैक्स पे करने के बाद और टैक्स और इंटरेस्ट पे करने के बाद जो भी बचेगा वो हमारा क्या होगा? अर्निंग होगा. सो दैट इज आवर अर्निंग इज 50,000. And the question is given that number of share, how many number of share you have given? you have given how many number of share, because you know equity share capital is 10 lakh and per share 100 rupees, so divide it by them, you will get 10,000 share, isn't it? So earning per share, so this is your earning, and how many share you have? You have 10,000 share, so earning per share is how much? 5 rupees per share. But here is the real question, how does financial leverage impact your business? So you have calculated all the parameter, but the question is, how does financial leverage impact your business? Now let's calculate the DFL, which is degree of financial leverage. Remember, DFL tells you how sensitive your EPS is to the change in your EBIT, right? So the formula is the formula is quite simple, EBIT upon EBT. So in this case we can see, what is your EBIT? EBIT is 2 lakh. What is your EBT? It is 1 lakh. It means 2 times. So it means that for every 1% change in EBIT, your EPS will change by 2%. So it is 2 times, right? So it clearly means that for every 1% change in, if there is a 1% change in EBIT, earning before interest and tax, your EPS will change by 2%. In simple term, a small change in your profit can lead to bigger change in your earning. That is why this is important, because financial leverage can amplify both profit and loss. In this example, a DFL of 2 times means you are using debt to increase your return. But be careful, leverage in action, right? So by balancing debt and equity, you can boost your earning and get more out of your investment. But remember, too much leverage can backfire. I hope you find this explanation useful. Now let's take another example to make your concept more clearer, right? So friends, let's break down another real world example to understand the DFL with XYZ Company Limited. Have you ever wondered how business use debt to amplify their profit? So let's take a deep dive into how financial leverage work and how it impacts shareholder return. Ready? So let's go. Let's start with some key number from XYZ Company Limited. So there is an XYZ Company Limited, right, for the year ending 31st March 2022. Equity share capital. Equity share capital is how much? You can see it is 50 lakh. Right, 50 lakh means they have share worth 10 rupees per share, right? 50 lakh share they are raising, 50 lakh amount they are raising by giving their share, right, in the form of equity share capital, and per share cost 10 rupees. Okay, 12% bond, they have issued a bond, they are raising fund using bond, how much? 37 lakh rupees, right? So basically they owe money via bond at 12% interest rate, that is coupon rate, and their total sales for the year is 84 lakh. Their fixed cost excluding interest is 6.96 lakh, right? And the profit volume ratio, that is PYV ratio, is 27.55, and income tax ratio is 40%. So got this number in mind? Great. Now let's walk through the process of calculating DFL in step by step, right? So how do we calculate the degree of financial leverage for this company? So again, I tell you that we will use this something called this picture, right? Let me draw it for you. I told you this is the most efficient way of understanding the data, right? So how do we calculate degree of financial leverage? How much is the sale? Sale is 84 lakh. So I write in 84 lakh here, which is our total pie chart. But we need to look at the contribution margin, which means money left after covering variable cost. And you know what is this PYV ratio? PYV ratio given is how much? You see it is 27.55%. So basically it says that 27.55% of this 84 lakh is your contribution. You just remember it, that whenever PYV ratio, that is profit by volume ratio, is given, it means what percentage of our sale is contribution, right? So it means that, so suppose this is your contribution. So what is 27.55% of this 84 lakh? Please do the calculation for me. How much are you getting? Please do the calculation. Please let me know that 27.55% of 84 lakh, how much you are getting. So I have done the calculation and I have got it to be, let me write down the number here, which is nothing but, let me use different colored pen. Okay, here it is, 2 lakh 31,000, sorry, no, just wait a minute. It is 23 lakh, not 2 lakh. I have got 23 lakh 14,200. So this portion is our contribution, and you know contribution is made up of two parts. The one part is our, let me erase it here. Okay, let me erase it and use it here. Just wait a minute. Okay, so here is our total sales, right? And this area is our contribution, which we have got how much? Which we have got 23 lakh 14,200. And you know this area is further divided into two parts. One part is your fixed cost, another part is, you know, other part is your EBIT, right? Now tell me whether fixed cost is given to you. See, fixed cost is given. How much it is? 6,96,000. So means this area is how much? 6,96,000. Let me use different color pen here. So fixed cost is how much? 6,96,000. So 6,96,000, right? So this is our fixed cost, means this with this area, right? So how much will be our EBIT? Just subtract 6,96,000 from 23,14,200. This will give you EBIT equal to 16,18,200. 16,18,200, right? So this is the profit that company make before paying interest and tax, interest or tax. So obviously the company has purchased bond, which is a kind of debt, right? Which is a debt instrument, you know it very well. And you know, for in bond, company has to pay interest. Now tell me how much interest company has to pay. Tell me. So for 1 year we are taking the data, right? So they owe how much money? 37 lakh, right? So they owe 37 lakh bond, 37 lakh rupees bond, and 12%. What is 12% of 37 lakh? Which will be 4,44,000. If you calculate the 37, just wait a minute, let me move to the non-word. Yeah, if you calculate how much will be your 12% of 37 lakh, this will give you 4,44,000, right? So after you subtract 4,44,000 from your EBIT, what is your EBIT? EBIT is your 16,18,200. So after subtracting, you will get 11,74,200. So this is your EBT, that is earning before tax, right? Now this calculation shows us how much the company is earning before tax after accounting for interest and fixed cost. But what is interesting here is that how this debt impact the company profit, right? So we know EBIT, we have calculated the EBT, that is what has been shown here, right? So EBT we got to know. Now finally we have to calculate DFL, right? So finally we have to calculate this so-called DFL. What is DFL? You know, DFL is EBIT upon EBT. You know it very well. DFL is EBIT upon EBT. So EBIT stands for earning before interest and tax. So EBIT is 16,18,000 and interest and EBT is 11,74,000, right? If you divide both of them, you will get DFL as 1.38 times. What does this number mean? So if the DFL greater than 1, you can see this DFL is greater than 1, isn't it? So this DFL is greater than 1. A DFL greater than 1 indicates that company is using financial leverage. Basically, they are using debt to boost profit. That is what I mean to say, that they are using financial leverage. You can see this word written here, that company has using greater financial leverage, because they are using debt to boost their profit. And if DFL is low, suppose it is less than 1, then it means that they have less leverage, means they are not using debt as much. In our case, we have 1.38. It suggests that XYZ company is leveraging their finance and their EBIT and EPS are moving in the same direction. And you know, sometimes what happen, that the negative and positive both happen. So positive DFL means firm operate above the break-even point, and EBIT and EPS move in the same direction. And negative DFL means that operating below the break-even point, resulting in negative EPS. So you must remember that it can be positive, it can be negative, right? So here is the thing, if DFL goes below 1, it means the company operating below the break-even point, and they could end up with negative EPS, not a good sign at all, right? So let's look at how DFL work in different scenario. Let's do the scenario analysis, right? So you can easily really get the feel for it. So the first case is no fixed interest charge. The scenario 1 you can see is the no fixed interest charge. Here is the situation where company does not have any fixed interest charge, right? Company does not have any fixed interest charge. So whatever I have told you regarding this positive negative, I will make you clear using this example. So first case, let's take when the company has no fixed interest charge, right? So in this scenario, EBIT is how much? EBIT is 1 lakh, right? And they pay 50% taxes. The tax is 50%. So how much is the tax they are paying? 50,000 tax they are paying. So what is their profit after tax? Profit after tax is 50,000. You see, profit after tax is 50,000, right? And how many number of share, right? So 10,000 share they have given. So what is their EPS? EPS is 5. How to do that? You just divided this PAT divided by number of share, right? Number of share. This will give you EPS, earning per share. How much you are earning per share? So you are earning 5 rupees per share. This is the scenario number 1, right? Now let's look at scenario number 2. in scenario number 2, what we have the, just now we have talked about the 2 scenario, that is what we are talking about, right? In scenario number 2, what is happening, that their EBIT increased to 1,50,000, right? And tax is same 50%, right? Scenario 2 is when we have positive financial leveraging, means they have taken interest charge, they have the interest charge there, right? So obviously in this case EBIT is 1,50,000 and tax is 75,000, so PAT is 75,000, number of share is still 10,000, and EPS is how much, 7.5. So what do we see here, that which is a nice increase, EPS has increased from 5 rupees to 7.5 rupees. So without any interest charge, a higher EBIT leads to higher EPS, right? So scenario 2, so now you look at this. So now look at this scenario 2 where we have positive financial leverage, right? So now add some interest charge to the picture. Here is where financial leverage comes into play, right? Here is where, so in this case, in the first case, you see either you take scenario 1 or scenario 2, there is no interest charge, right? There is no interest charge, only EBIT has increased, so EPS has increased. Now let's look at scenario 2 where we have positive, we are using positive financial leverage. So here we are adding some interest charge. In scenario 1 we have EBIT of 1 lakh and interest charge of how much, 20,000. So after subtracting it we get 80,000, EBT is our 80,000, and then we have to pay tax, which is 40,000. So profit after tax will be 40,000 and number of share is still 10,000, so EPS will be 4. But now in scenario number 2 where EBIT was 1.5 lakh, so 1.5 lakh EBIT, interest is still 20,000, EBT is 1,30,000, 50% of this is 65,000, and subtracting this we get profit after tax is 65,000, so EPS is 6.5, right? So what is the takeaway? Even though both scenarios show the rise in EBIT, the interest charge in the second scenario helped the company magnify their profit, isn't it? Because you know, in both the scenarios show rise in EBIT. You see, here also EBIT has risen by 1.5 times, and here also EBIT has risen 1.5 times, but EPS has rise by 5 to 7.5 and here 4 to 6.5. So it means that in the second case, when we are taking interest into account, when we are taking positive financial leverage, what is happening, that company magnify their profit, which result in higher EPS. This is a positive leverage at work. Now let's look at the scenario number 3, which means break even. So as you can see, financial leverage can be a game changer. When used wisely, it can boost a company profit and help increase the EPS. But of course, using too much debt can be risky. Now let's look at the scenario number 3. So friends, we are looking at the break-even level and how operating leverage plays a big role in the company profit dynamic. So scenario number 3, imagine a company where EBIT, that is earning before interest and tax, is equal to their fixed interest payment. That means EBIT is equal to fixed interest, means whatever profit they are generating is equal to cost. Interest is the cost for the company and profit they are generating is EBIT, both are equal. Like in this case, like in the previous case, suppose our EBIT is 1 lakh and interest is also 1 lakh. So both will nullify, right? So both will nullify. So this means the company had just enough earning to cover its interest cost, but no profit beyond that. So in this case, what will be EBT? EBT will be 0. EBT will be how much? EBT will be 0 because no earning, right? After paying interest, company is getting 0 as earning, right? So no profit beyond that. So tell me, what will be DFL? So you know the formula of DFL. DFL is equal to EBIT upon EBT. You know this formula. And you know, when something is 0 in denominator, the numerator become undefined. So this DFL is undefined. This DFL is undefined. Why? Because without any profit before tax, that is without any EBT, the formula become meaningless, like dividing by 0. This is why we say it is undefined when the company reaches the break-even point, when its EBIT just cover interest cost. Now let's look at scenario number 4, below break-even point. Let's understand it. What is the meaning of below break-even point? So let's say the company EBIT is positive, that means they are still making money from their core business, but their EBT become negative due to excessive interest cost. Now let me give an example. Suppose EBIT is 1 lakh, right, and their interest cost is suppose 1.5 lakh. So what will be EBT? EBT will be negative because the cost is more than profit, right? So EBT become negative due to excessive interest cost, and this is a dangerous situation for the company, because negative EBT means they are not making enough money after paying interest to even cover tax, let alone generate a profit, right? They are not making enough money after interest to pay for tax, leave the profit. So here the DFL is become negative. This indicates that company is operating below its break even, and the more leverage they have, the worse their financial situation get. So it's important